intriguing, slightly urgent tone. A single, unnoticed financial habit is quietly vaporizing over $1 million of your potential lifetime wealth right now. This drain persists even for individuals who skip the daily lattes and obsessively track every stock market fluctuation. The phenomenon is lifestyle inflation, an automatic process where spending grows in exact lockstep with your increasing income. When a raise hits, the extra income typically triggers an immediate sequence of upgrades: a larger apartment, a newer vehicle lease, more frequent travel, and growing monthly subscriptions. This creates a specific financial trap. You arrive at the highest salary of your career while mathematically running in place, saving nothing because your expenses have expanded to swallow every new dollar. To see the long-term impact of these choices, consider the exact moment a worker receives a $500 monthly pay raise. Most people follow Path A, where that $500 is immediately absorbed into the monthly budget to finance a more comfortable daily life. But Path B offers a completely different outcome. In this scenario, the entire $500 is diverted away from the checking account and routed directly into an investment portfolio. This graph illustrates the power of Path B. By investing that $500 every month at an average 10% annual return, the account reaches over $1 million after 30 years. Under Path A, the money was spent on temporary upgrades, meaning the total accumulated wealth remains at zero. The gap between these two lines is the literal cost of the lifestyle upgrade. The price of a nicer apartment or a newer car is actually the sacrifice of that future million-dollar portfolio. Humans consistently choose the path of instant spending because our biology works against long-term mathematical logic. This is driven by a concept called hedonic adaptation. Our brains are wired to normalize new surroundings quickly, which rapidly diminishes the satisfaction we get from a new purchase. Within weeks, the excitement evaporates. This creates a psychological hunger for the next upgrade, even if the previous one didn't make us happier. Social media accelerates this cycle by providing a daily stream of curated luxury, raising the baseline of what we feel we need to own to keep up. The reality behind those curated images is often found below the surface. As this chart shows, the appearance of wealth is frequently financed by high-interest debt that remains invisible to the public. Lifestyle inflation is a struggle to defend yourself against biological impulses and social illusions that encourage you to spend every dollar you earn. Financially independent individuals operate with a specific set of rules that differ from the reactionary mindset of the average consumer. They treat a pay raise as capital for acquiring income-generating assets rather than a prompt to increase their monthly overhead. Their finances are engineered to be mechanical. They automate their investments and build emergency funds before that money ever becomes available for daily spending. This shift requires changing your primary objective from the performance of looking wealthy to the objective reality of being financially free. True wealth is quiet. It is measured by the total value of assets you own rather than the items you display to others. Escaping the cycle of lifestyle inflation requires following 3 specific rules for every future increase in pay. Rule 1. A fixed percentage of every future raise must be routed into an investment account before you adjust your monthly budget. Rule 2. Avoid buying depreciating assets to impress peers. Focus instead on building the pillar of income-producing assets shown here. Rule 3. Track your personal progress based on the total of your net worth, not the size of your monthly paycheck. Your next raise will either disappear into monthly bills or be the specific capital that eventually replaces your need for a paycheck. The choice is made the moment the money arrives.